Some of the biggest failures in technology didn't happen because the technology was wrong. They happened because the financial structure around it broke. The telecom boom of the early 2000s is a perfect example. Today, AI is showing some familiar financial patterns. Welcome to The Wise Analyst, where we break down finance, strategy, and psychology without any noise. Before we talk about AI, let's understand one idea with a simple example. Imagine a bank and a bakery. The bank lends money to the bakery. The bakery uses that loan to buy ovens. But those ovens are sold by a company that is also financed by the same bank. What happens next? The bakery shows growth. The oven company books revenue. The bank earns interest and fees. On paper, everyone looks successful. But step back and ask a simple question. Did real external demand increase? Or did money just circulate inside the same system? The money never truly left. This is circular financing. It doesn't mean the bakery can't sell bread. It means growth is being financially supported, not purely market-driven. Now let's scale this idea up to AI. AI today is not just about models, data sets, or breakthroughs. It's also about how capital moves. Recent headline deals make this clear. OpenAI and Oracle announcing a $300 billion cloud commitment. OpenAI and Nvidia discussing up to $100 billion in conditional investment tied to GPUs. These aren't just technology partnerships. They show that financialization has moved deep into Silicon Valley. Let's take Oracle. Oracle has agreed to host OpenAI's computing needs under a deal often described as being worth around $300 billion over the next decade. At first glance, that sounds like guaranteed demand. But here's the important part. That money doesn't come from millions of small customers deciding to spend more on Oracle. Instead, Oracle has to build massive data centers up front and then offers very favorable terms so that OpenAI can actually afford to use all that capacity. In simple words, Oracle builds the capacity. Oracle then invests in OpenAI. OpenAI then spends that investment money on Oracle's cloud. And Oracle records that spending as future revenue. So from Oracle's point of view, money goes out as investment and comes back as reported growth. Nothing illegal is happening, but it does blur an important line. Is this demand coming from the market or from Oracle's own balance sheet? That distinction matters. Now look at Nvidia. Nvidia has discussed up to $100 billion in equity investment in OpenAI, but that capital is conditional. OpenAI must spend even more billions on Nvidia GPUs. So financially, what's happening? Nvidia provides capital to OpenAI. OpenAI uses that capital to buy Nvidia hardware. Nvidia records to a strategic investment on one side to soaring GPU revenues on the other. The same dollar leaves Nvidia and comes back as revenue. Again, legal, disclosed, rational, but structurally circular. From a financial perspective, circular structures create risk. 1. Double exposure. Oracle and Nvidia are exposed to OpenAI twice, as suppliers and as financiers. If OpenAI slows, revenues fall and investments lose value. That's leverage squared. 2. Distorted incentives when suppliers are also investors. Models may be optimized for Nvidia chips. Workloads may remain locked into Oracle's cloud. Even if better alternatives appear, financial commitments make switching harder. Accounting opacity. If capital goes out as investment and comes back as revenue, is that genuine market demand or internal recycling? This is where finance begins to dominate technology. If this helped you think a little more clearly, liking the video and subscribing the channel tells YouTube to show it to people who care about substance over noise. We've seen this structure before. In the early 2000s telecom boom, equipment vendors financed telecom operators. Operators borrowed heavily to buy more equipment. Vendors booked explosive revenues. Massive capacity was built ahead of real usage. Routers then look a lot like GPUs today. Fiber networks look a lot like cloud data centers. The technology wasn't useless, but financial structures amplified demand beyond reality. When growth slowed, the unwind was painful. AI is real, AI is transformative, but strong technology does not automatically mean strong economics. When CAPEX turns into revenue, when investors become customers, and when growth feeds on itself, valuations can detach from reality. The most powerful algorithm today is not an AI model, it's the balance sheet. Applaud the ambition, but always follow the money. If you like understanding how finance, strategy, and psychology quietly shape the future, you're in the right place. At The Wise Analyst, we break down finance, strategy, and psychology without any noise.